pretty cut and dry with stuff, man. Not everybody's as clean and crisp and cut and dry as you, brother. That's all. I mean,
I mean, at some point, it's just you just gotta call it for what it is. Man, I guess it's a lack of being professional on my end. I guess.
no, that's on our end. You're professional. We're not. You are professional.
I mean,
Entrepreneurs like me are not professional.
like I say, I have my slip ups. Like I said, I'm not perfect either with this stuff, but it's like, okay, you try and get to a result. Okay, here's the answer. You may not like it, but here's what you need to do. A lot of people just don't like to hear answers they don't want to hear. I was actually talking to my team about that this morning. Um, just kind of different client calls as wrapping up stuff. I was like, yeah, you owe $45,000. You took out a whole bunch of money from your
Mm.
retirement account. You didn't invest into anything,
Oh no.
and there's no recourse for you at this point. So it's like you deal with the bill as is, and as calmly as I'm talking to you, that's how I explain to people. Like I say,
You
those I
cut
mean
throat, Larry.
those. Like I said,
Cutthroat, man.
I mean,
Larry, oh my lord! I'm sorry you owe 45,000. What do you want me to do? Shit, it's on you. I ain't
yeah,
gonna do.
what? I tell you, like, there's no magic happen here. Like, you waited until after the year to get with someone,
Bad move.
and
Did they
because
set the money aside though? Is the real question. I want to know how much did they set aside a month?
I don't know what they end up setting aside. They really didn't get into that part of the conversation. It was just, I mean, I think they did because they ended up just um one because you can do the auto withdrawal from your account or you can go online and pay. So they decided to do
Okay.
auto withdrawal. So it's like,
All right.
okay,
So they
they,
set
they
aside.
put the money aside. It's just, do you like, it's daunting hearing a number like that.
Well,
But
if you set it aside, then no big deal.
yeah,
$50,000.
you
Here,
set
boom.
aside, like you took out nearly $500,000 out of your retirement account.
Oh
Like
man.
you're rather blessed from that perspective because I mean some people won't see that in a lifetime.
No.
A lot of people won't see that. Most people in the world won't see that in a lifetime. So like I said, I don't feel bad. Like it's unfortunate, but it is what it is. Now, do you want to keep dwelling place going forward so you don't happen again? Because you're saying you plan on doing the same thing in 2022, or you have done it. Now,
Mm.
have you bought any investments to help offset that against?
Mm.
Have you started a business? And I tell people like the tax code is not made for employees. There's some benefits here or there. You can get your some deductions on your contributions and medical expenses paid out of pocket. Like you'll get some there, but for the most part, it's for business owners and investors.
Wow.
And if if nothing in your lifetime has shown you that, then you have probably lived a pretty sheltered life, or uh, just continue to complain about the situation and
Wow.
not actually learn how the wealthy or those with knowledge are using the system to their advantage,
Mm.
which this what the system want them to do. People think the government makes a lot of money off of the everyday person, which they do, but they make a lot more money off of investors. Like they made a lot more money off of you, all the housing you provided, and then those people pay and pay taxes, and those people pay sales tax and personal property. Like they may not be able to do that if you haven't provided them the housing.
That's deep, Larry. That's
So
deep, man.
it, yeah, kind of like it's I try to be direct like that because I just try to cut straight to the point, and my time is valuable. So it's like I'm not going to sit here and try to tiptoe around the situation. Like here's the issue: how are we going to address
Wow. That's deep stuff. Roundup, thanks for coming up with us. Larry was just performing a quick bit of surgery there as he told me how blunt he has to be with some of his clients. Thank you for that, Larry. Welcome to the Roundup Network. I am Chris Haskins. I'm your pilot for today, hanging out with my co-pilot, Larry Pendleton, CPA. What up, homie?
it? It's good, bro.
It's good to see you. I missed you the last 2 weeks. I'm starting building my house, back to school, all this stuff. So now we got a little time to breathe. Thank you for your patience, Larry.
No, no, man. This is your world. I'm just living in it.
I know you're super busy. And me and Larry go back and forth. Y'all have no idea how challenging it is just to get this here today because Larry's busy. Y'all know I'm crazy. 3 kids. He got kids, wife. Ooh, we here. We made it. So, Larry, before we get into today, we're talking about tax tips for rentals, renovation costs for tips for rentals and flips. We were talking about my client earlier when we before we got on. He has some rental issues. You were asking me how I deal with people regarding not wanting to kick people out of their rental properties. You own rental property right now?
Yes.
Do you have?
Actually closed on another one. We closed on one last week out in Hampton,
Good for
uh,
you.
by Buckrow Beach. So looking forward to get that one. We'll start renovations on that one next week, actually.
I love that you are a CPA that actually buys real estate. You actually do the real estate. You don't just. So tell me about your. Do you use that same character, that face that you explain taxes when it's time for eviction, Larry?
Well, I don't really get involved with evictions. I know my lane. Like, even though I'm rather direct, I'm pretty soft-hearted. So I know I
Rather, you're rather direct.
yeah,
Okay,
I can be
you're
rather
rather.
direct, but I'm also can be a bit of a softy as well. So like
Okay,
we have like property managers in place and people that kind of handle that or get the attorneys involved. Like I don't I I I, I
you're
see that
hands off.
the big yeah. I'm trying to be hands off from that perspective, making sure the legalities of it is squared away. Um, I sit here and learn all that stuff and go to court and like yeah I can, but I'm running a whole separate business that
Gotcha.
I don't have time to so that 8-10% that I'm paying like that's my time that I'm getting back.
Oh,
So
okay, cool. So you're not hands off with that stuff.
yeah, but my property managers are bulldogs, so like they're like I say they don't really play those games. I mean, like we try to work with people. I mean, especially throughout COVID, like we know there were people that really needed help, um, and we talked that through with the manager because let's get all this. But we do a historical background check on them of okay, are they just playing this game that a lot of tenants did throughout COVID?
Mhm.
So, but
Yeah, they did.
you don't want to throw everybody under that bus. But it's like okay, there's some people that don't deserve the help because you go buy the property and they got a brand new car and they
Yeah,
say and they can't pay rent. Like, okay, let's go ahead and get them out at that
that's
point.
true.
But if it's someone lost their job, we'll put the proper extensions and all that in place. We get the rent relief and all that come in, but we don't rely too heavily on that because how slow it is, and
Gotcha.
it can really hurt your business.
Cool.
Without with all that trying to wait on relief money to come in. So
Yeah.
all is all case by case, but we get the right
Okay.
table to talk it through.
So today we're going to talk about some tax tips, pros, cons regarding doing renovations on your flips as well as your rentals. So Larry's a CPA. He's been doing this for years, buys real estate, and today he wanted to kind of share that stuff. So I'm here to be the vessel for and the stage platform to Larry to spread the good word of how we can help our investors. Larry, what is your first
Appreciate,
thought on this stuff?
appreciate. So, I mean, as we're getting to the fourth quarter, and a lot of people are looking for tax saving opportunities, and people are still closing on deals, closing on flips, especially as the market starts to soften, depending on how you look at it. I mean, there's still flips happening. So when you're and I still see this mistake a lot with a lot of flippers of they're getting all this work done, they're paying for all these contractors, and then they're trying to write off the costs of that in the year that it occurred, but the property haven't sold yet. That is not you cannot do that. The property itself is considered inventory when it comes to flips. The renovations that are going to is adding value to that. So from an accounting standpoint, we're looking at your balance sheet, the costs, the rehab costs, all that is not expense until you sell the property.
Give us an example, Larry. Give us an example. Paint a picture for because I want to make sure everybody understands just the moving parts in that because you're still spending the money. Like how in the hell you mean I can't? It's in the same year that I mean I just spent the money.
Yeah.
Give us an example.
Where we at?
Oh, we're breaking out the white. Whiteboard.
I was trying to bring out the white. I was trying to get fancy with it. Now I'm
You
trying.
can go ahead. Y'all get your questions in with Larry CPA. And also give us the thumbs up. Hit the like button down there, you guys. You know I got much love for you. Tomorrow, the Land Trust Workshop starts at 4:30. Make sure you're here. I'm going to show you how we buy and sell houses without putting them in our name or our LLC's name. Okay. Be here tomorrow. We'll right back here. And you're gonna get some goodies too. You ready, Larry? You got your thing?
Yep. You see my screen?
Yep.
Okay. So let's just say you bought a house for 100K that you plan on flipping. Let's so you already got financing in place and all of that. So like all like the closing costs and all of that, that's all still related to the property. Let's just say I'm just trying to keep the numbers clean. Let's just say it's 10K in closing costs, and then there's 30K of work needed. Now, all of this is considered the value of the inventory itself. Because the IRS like sees properties that are being flipped or kind of held from a short period of time. They honestly don't really see those much differently than buying and selling shirts at that point. So really you have $140,000 on your balance sheet for one property itself. And I know what a lot of people are thinking the closing cost is cash out of pocket, the rehab cost is like that's cost that I'm that I'm paying out of pocket this year. Like, why can I not write that off? Because this inventory is still on your books, and that's just how it's deemed to be from that standpoint.
Wow.
So if you, I mean, so really, it just kind of sits there, and then you'll roll into the year. So let's say you don't finish the flip in 2022, it goes into 2023. This 140K is your ending inventory at as a 2022. So let's just turn around and say, hey, you didn't turn around and sold the property for so in 2023 you sold the property for 240, whatever number it is, from that standpoint there. That's when you're able to write off all the costs associated here. And honestly, you want that to happen because you don't want to just recognize a $240,000 sales price on your like of income on your tax return. You have nothing to offset against because you try to recognize it all in year one. One is incorrect. Two, you'll have a huge tax bill the year that you do sell the property. So instead of it being the $240,000 of taxable income, you got that 140 and all the costs associated with it. Now you're only looking at 100K in taxable income in 2023.
Mm.
So and like I said, and we'll get into the rentals and all that later, but this is why I wanted to kind of break this down a bit more for the flippers and anyone else that's kind of just doing these short term these short term transactions. And also keep in mind that because it is a flip, it's not taxed on the capital gains, where it's 0, 15, or 20%. It's taxed on whatever your effective tax rate is, which is a combination of all the tax brackets that your total income flows into.
Gotcha.
So, because this is all considered business income at this point, it's not a capital gain, or even if you sold at a loss, there's not a capital loss here to be really play a factor here. It's all just considered taxable business income.
Gotcha.
And depending on how many flips you're doing and all that, we don't want to get in the weeds, but you're potentially getting hit with self-employment tax. But that's a whole nother topic there.
Yeah. I
But
don't want to get into that, Larry. Not that I know anything about. I mean, okay. So I'm doing work. I guess what we call it, the base is the basis of all. Once it's all done, that's going to be our basis when we sell it.
yeah, so that's basically your cost basis of the property itself. So what you paid for it, the closing costs, any fees. Now there are certain expenses that incur during the year that you can write off. So any interest on that property, any taxes that you paid on that property,
Real estate tax you talking about?
yes,
Okay,
and or the mortgage interest or wherever you're getting your
insurance.
financing from that front is because someone has made money on that income and is not truly directed on the operations of that property itself. Like you can still flip that property and not pay any of the like you'll have an issue with your lender at that point, but and especially with the tax if you don't pay the taxes on it. So like that stuff you can recognize. But anything regarding the actual build out of that property, the renovations that's being done, keeping the lights on, all that stuff, paying contractors, make sure you get your 1099s out. It's like that's like that all goes into that basis and then helps offset the income that you make on it.
Gotcha. All right, so that's for the flips. So let's switch gears and talk about. Or are we done with flips then on that,
Yeah,
Larry?
so
Oh, we
pretty
were just.
straightforward from a flip perspective. Like I said, I mean, I'm happy to answer any questions, but I mean, I didn't want to get too much into the weeds, but I just want to, hopefully that was clear and precise to what people need to be kind of looking out for. Their flipping properties late in the year and still may have it still outstanding before when the calendar turns.
Just happens, man. I mean, I know we got several of them out there that just, I mean, how it is. So we got to make sure to remember that. I mean, obviously they're doing it, but
Yeah.
okay. So tell me about your rental properties and Larry. Obviously we're holding on to the rental property from year to year, so that wouldn't
Mm.
pertain to that.
Yeah, so now when we're talking about the rental properties themselves, the rehab, it's I get a little more anal with my clients when it comes to their rental property rehab is
You can get
because
more. You mean you can get more?
yeah, I gotta get a little more anal because those where the tax savings are from that standpoint. I tell people like there's a lot when it comes to because if you're doing the people just trying to take, hey, I got this contractor, they're charging me $20,000 to do all this work, and here's their invoice. Um, that's nice and all, but if you just give me a $20,000 invoice and you tell me there's major renovations being done, we're gonna have to capex that, which means we have to depreciate that over 27 and a half years. Now that's because that's money out of pocket year one, and you're slowly recognizing that as an expense over over 25 years uh, to from that standpoint. Now, how we combat that is that we have to really push back against the contractor, and we really want to get them to provide itemized invoices of the work they're doing and the cost per the work they're doing. And one
Itemized.
and one of the reasons why we want to do that is because we want to take advantage of the minimum safe harbor tax opportunities there. And without going into a whole bunch of detail, the minimum safe harbor basically is saying that at the invoice level, if it's at $2,500 or less and not considered a major component of the property itself, you can expense that. No questions. I won't say no questions asked, but you can expense that with the proper supporting documentation in place. So you may not be able to write off that full $20,000 invoice from that contractor from that rental property of yours, but you can possibly 10, 20, 30%, if not more, depending on the work that was done. Because let's just say they're doing painting for your property. Let's just say they charge you $2,000 for the painting. If that's wrapped into that $20,000 number, like how am I supposed to know that as your tax advisor and as your carrier as well? Painting is not capex item. Is actually can be considered repairs and maintenance, and we want to expense that. So like, hey, get them to break down their invoices, itemize like it's a pain in the ass for them because they're not here for paperwork. They probably don't really have anybody in their office to help break this stuff down,
Mm-mm.
and they're not used to most investors asking for stuff like that. But
Mm-hmm.
if you're dealing with a tax advisor who knows that there's tax saving opportunities there, then you need that information to help benefit you in the long run. Plus, you're the
Gotcha.
client, so if you're asking for it, then it's kind of goes back to our conversation a few weeks ago regarding 1099s. Are you dealing with contractors that know how to deal with this stuff, or knows how to give you the information that you need, or so you can claim these deductions? Because if you're dealing with contractors that don't want to get 1099s and don't want to provide itemized invoices, you may be missing out on a lot of deductions in your business.
Mm-hmm. I don't think they should be dealing with anybody unless they're doing 1099, Larry. Do you have an opinion on that at all? I'm like, I don't even want to do. I don't do like if I don't do a 1099 or W9 with you, I can't do business with you.
Yeah, and I get it from some investors who are just starting off and they're just trying to go the cheapest route as possible, but
Yeah, that's
also
true.
tell them like you kind of get what you pay for in those type of situations. If someone's not above board with what they're um, providing with the IRS, now like are they going to be completely up board, like keeping you up to date and keeping you informed of all that stuff as well? I'm not saying everyone's perfect and all of that, or anyone's perfect, but to truly benefit like the larger businesses, like the larger investors, you have to start thinking like them. And
Yeah.
what all of them doing, I don't care. You go to any Fortune 500 company, you can do Fortune 1000 company. I don't really care. Any major company, they are getting W-9s from all their contractors because they're going to be issuing out 1099s. They're
Period.
crossing all the T's, dotting all the I's, because if that person doesn't want to do it, there is someone just as qualified, probably more qualified to do the work and can get you information that you need. Plus, on the invoice side, don't you want to know what you're paying for? So they just gave you 20,000. Like what did that like? How do you know if that's a reasonable cause, or how to shop that against other contractors? And I'm not really picking on contractors. Like, how do you really know what you're really getting if you're just accepting these large invoices that don't really you don't have a scope of work from that standpoint there. So before we be talking about the taxes, just operationally, does it make sense for
Wow.
that cost for the amount of work? And then turn around and say, okay, I need that to know if I'm getting charged appropriately, and I need that the for my taxes as well.
We got to have them joints, man. Please, just do it, man. You don't want to be like me getting audited. Be like, yeah, I paid him 10 grand. Oh yeah, here's the cancel check. Well, how do we know you didn't just write the man a check and give you the money back? How do you know?
Yeah,
You don't know. Yeah, you don't know. So the 1099s is like cut and dry. Ain't mine, is yours.
yeah. So
So
I may get some hate mail from some contractors, but
they don't like it though. Like, what do you mean? I gave you the price. I gave you the price without the taxes. I'm like, just give me the price with the taxes. I
yeah,
don't even want no
just have it
taxes.
all laid out. That covers you on the front end for the 1099s, and then when it's time, when you say, hey, can I tell people, like, do not give me a summarized invoice over $5,000. Like, I will push it back to you and tell you to go call your contractor and ask to be itemized,
Yeah.
because I'm trying to squeeze as much juice out of this and provide tax saving opportunity for you. And that kind of goes back to my cut dry demeanor at that point. Like, if I'm not direct telling you that, then okay, we'll sit here and wait. Or here's your tax return. You owe this much. There could be some tax savings here, but you haven't talked to your contractor yet.
Mm, gotcha.
So
Itemized.
it's a two-way street. Like, we just like, it's more than just taking information and throwing it into a system and producing a tax return. Like, no, there's some analysis that needs to be done, and it's a team effort here. And my part of the team is to inform you of what your opportunities are, but you got to put in the work as well.
Mm-hmm. So round up, homies. If you're just joining us, I'm here with Tax Talk with a CPA, Larry Pendleton. If somebody wants to get in touch with you, Larry, oh, let me. I'll do that. I always forget to do that. You got a little thing right there. And what is the best way to reach you for a consultation, Larry?
Yeah, so the QR code would take you to my page. You'll see other stuff that I've been in. I believe, yeah, I think I added a link to your page as well, Chris. So
Cool.
so
Appreciate
everyone
that.
can see all the stuff I've been on, and then you can get on my Calendly link and schedule a consultation or intro call, and we'll roll from there.
So, Larry, could you just touch a little bit about depreciation recapture? Because I very rarely sell any rental properties, right? And I don't even do like these repair issue stuff. I'm like, I just don't even have them because I don't do a lot of repairs because we do lease options and stuff. The
Mhm.
tenant does. I mean, I'm like, just pay the rent and I'm so depreciation recapture for my roundup homies, just so we can kind of get a grasp when we go to sell a property we've owned for, let's say, 10 years.
Yeah. So to kind of take it back a bit, depreciation recapture is based on depreciation. Depreciation is basically a government incentive to entice more investors to buy more rental properties. So we're not talking about flips, wholesale. That's like none of that stuff really matter. We're only talking about buying whole rental properties. So the incentive is that the government is recognizing there's normal wear and tear in the building, and we'll give you a portion of the building value over an extended period of time. Basically 27 and a half years for rental properties, 39 years for commercial properties or short-term rentals. The benefit of it is that that is a non-cash expense that you can claim on your tax return. You didn't pay no money out of it from that standpoint. Another way to kind of look at it is that the principal on the loan that you're paying, if you do have a loan, isn't deductible. So it almost as sometimes kind of matches the somewhere around the principal balance of your loan, if you have one in place. Not all the time. I just like to kind of point that out at times. So depreciation recapture is basically the end of the contract that you have with the government. You bought this rental property. The government's like, hey, thank you for providing housing to the masses. As an incentive, here's depreciation. Once you sell that property, you have broken the contract with the government. The government now wants that money back because they're going to give it to the next investor. From that standpoint, that's the recapture. They're recapturing all the depreciation that you claim on the property itself.
Mhm.
So, for example, if you bought a property for $100,000 and in your 10-year example, you sold it in year 10 for $200,000. Your thought process is that, well, I have $100,000 gain on the property. That would be an easy assumption, but it's also incorrect when it comes to taxes. Because let's just say out of that 10-year period, you actually recognize $50,000 of depreciation throughout that time. I'm just throwing out numbers right now, nothing real exact at this point.
Yeah.
So instead of your cost basis being $100,000 and you sold it for two, that $50,000 now plays a factor, and your cost $1,000. So you're now being taxed at $150,000 gain, not $100,000 gain that you originally thought from that standpoint.
Mhm. That's
So that's
nasty.
that's your recapture there. And there's ways to get around it, whether it's doing 1031 exchanges
1031. Yeah.
or even for a year like year with the bonus depreciation, where okay, you may buy something bigger and then use that and the losses off of that to offset the gains on the sale of the property
Mhm.
that you just sold. I imagine consulting with somebody in a couple of hours about that. So
Okay. That's good.
there's opportunities to help eliminate or continue to defer those taxes, because depreciation always eventually comes due. We all eventually going to sell these properties that we have.
Or
Uh,
die.
yeah, or you die. Once you in the real estate game with the government, like there's no easy transition out. Like you're going to be involved with real estate either actively or passively. You're either going to keep 1031 in, or you're
Dang.
going to just keep trading up, and just maybe in a passive position where you're not involved with all the day-to-day operations with the property, and potentially pass the property down to heirs and do the whole swap till you drop. You just keep 1031 up and up, and then uh, as the day of the laws don't change, your heirs get the benefit of the step up basis, where they get the property at the fair market value and not your book value. So that's the game.
What does that mean?
What do you mean
Fair market value, not the book value. What does that mean?
so on the $200,000 $100,000 example. So if you would have sold the property to your heirs at the 200,000, you didn't have to deal with the $150,000 capital
Game.
gain hit, and then they got the property at what they bought it, what you bought it for. Now, if you just gave the property to your children, you're still dealing with a taxable event there, and then they only have the property valued at $50,000 or a basis of $50,000. So if they would have turned around and sold it for 200, then they have to deal with that gain.
Mhm.
Now, the step up basis basically means that when the day of your passing, you pass away in 100 years from now, and that property at the fair market value, or what people are willing to buy stuff, is at, let's just say, $1 million. Your child now has $1 million property on their books, and if they would have sold it the day after your passing at $1 million, they are now paying no taxes on it.
Mm,
But
I
anything
see.
before that, they're getting at that $100,000 value or whatever it is minus depreciation. Minus depreciation, they try to sell it for $1 million. They gotta pay that gain between what they got it as when you gave it to them, not inherited, not what they inherited, and then what they sold it for.
Yes, and maybe we'll cover that in detail for one of our tax talks, Larry.
Yeah,
That might
we
be a
can
good one.
definitely. I mean, depreciation is what makes real estate one of the best investment tools when it comes to tax implications. There's not. I mean, people, you can get depreciation on vehicles and anything, but we're talking about like high dollar, like $1 million, multi-million-dollar properties. There's not too many other investment vehicles providing that type of non-cash benefit like real estate does. Because a
I'm
lot
just
of taxes go from you got to keep paying money out to get the deductions.
that's
And then,
crazy, man. Yeah,
so
it's
if there's ways that you can get deductions without paying a whole bunch of money out, i.e., putting
expenses.
40% down on a $500,000 property, but you get 100% of the benefits of depreciation, like you take advantage of those opportunities within the tax code if it's a good deal. I mean, make sure
That's
I
deep.
explain that part.
That's deep, man. You don't think about this stuff. Well, I know I didn't think about depreciation, recapture, or any of this stuff until you start getting some stuff. You got some stuff, right? Like, man, what am I gonna? My mentor says, Chris, offense, earning money is offense, but managing it is that defense. And I just don't think we're taught. I was taught zero defense, like all offense, offense, offense,
Yeah, people are typically really good at making money.
earn.
How to truly, and because it's such an individual thought process when it comes to it. When you're talking about the defense of it and how you manage and how you keep as much as you may, the team sport aspect. I mean, there's a team aspect of it when it comes to making money, but when you're talking about you're running this business and now you're gonna try to turn around and be the attorney for your business and turn around and be the tax advisor for your business, at some point it's best to bring in professionals. Like I said, I had a property manager in place since I bought my first property. Like I was just self-aware of myself. Like I don't want to deal with this at all. And I'm not looking at it from just this one property. I'm going to continue to expand and grow. I need someone to help me manage these things along the way. So I'll bring in people early, um,
Mhm.
and grow from there. I'll take
Gotcha.
it this far. Like I think I may have told you this before. Was like I have a bookkeeper. People assume that
What?
I do. Like I don't do my own books. Like I don't have time to do my own books. I know how they supposed to look. If my bookkeeper gives me something that looks odd, like we're having a conversation, but the day to day grunt work and stuff, like no, I'm gonna grow this business. I'm gonna try. I'm trying to consult people. I don't have time to do every single aspect of what's going on in my business.
Yeah.
I let my pros and my specialists do their thing.
That's cool. Well, Larry, I had you for 30 minutes. I think we'll have no questions today. Thank y'all. Make sure you guys give Larry a thumbs up, man, for taking the time out to bless us with this thing. I mean, a consultation would cost money to do that, and he's educating me and all of us at the same time. So, Larry, once again, man, thank you, thank you, thank you.
No, I appreciate it. Yeah, just let me know. Like I said, have to answer any questions, or if anybody want to reach out, like I said, we can always chat and grow from there.
Yep. Okay, cool. So round up, get your hit that thumbs up, like the content, subscribe to the channel, share this information with anybody else that's even getting into real estate or already in there, and they try to figure out how to navigate all this real estate stuff. Ed Middlebrooks, of course, Ed would have something that is going to be high level. Ed, do you ever use a spendthrift trust? Larry,
I haven't heard of a spendthrift trust.
of course, Ed would know that.
I'm aware of trust is. I guess Ed, is that revocable or irrevocable? I want to
He's
understand.
oh yeah, I don't know. He's you think I do the most? This guy is just on 1,000, or do you advise? I guess that's the answer. No, I don't know. Is it a
I mean, when it comes
revocable?
to just trust in general, like I say, it's just making sure. Because I know you're really big on trust. From that standpoint.
That's just
Uh,
for real estate. I'm not talking that. I mean, those trusts is irrevocable. Those are my trusts are just strictly for real estate ownership.
yeah,
But
I
go.
mean, it's the main aspect of it is because you got your revocable living trust that you're using really to protect your name, and but
Hmm.
overall it still is reported exactly the same on your tax return. Um, so people
Exactly
think
the
there's
same.
like there's separate filings. Like, no, that's when you get into irrevocable. I saw Ed mention that as irrevocable.
Yeah,
So it probably is probably a bit of aspect of how much it did of the funds that's being made by the trust is being allocated to the beneficiaries.
there
So
you
that
go.
because your trust irrevocable, you're looking at 37%, somewhere in that range in taxes. So it's like, okay, is there children or someone else at a lower tax rate where it's like, okay, business made the money. Now I'm gonna pass that on and not get taxed too harshly on that standpoint. So
Hmm.
I'd like to learn more. I have to write that one down.
It always, always, always. My kids say I'm doing the most, but I would beg to differ. Ed always got some, yo. He would hire experts to get all the information and get it all, and he'll wrap it up in a bow. Ed, much love to you, DeAndre. Why my Wyoming LLC, and he knows I'm telling the truth. Holding company, and it owns. He got deep. DeAndre, what up? Owns my other LLCs. Should I push everything to my holding company from a tax perspective?
It
What do you think
depends.
about that?
So I mean, the question is, okay, what are the businesses of the other LLCs, and is the Wyoming LLC just a shell of roll everything up to, or is that operating a business from that standpoint? So
Yeah, I
I'll
don't
need to
know.
kind of learn more about what the other businesses are, because if it's
That's
a
true.
mixture of you have a flipping business and you have
Information
a
products, rental
yeah,
product.
you got clothing business and you got rental properties. Like, I don't really recommend all that stuff rolling up into one Wyoming LLC, because that LLC will then potentially will need to be S corp election, depending on how well the flipping business and all the other active businesses are growing. So we can help mitigate the self employment tax, and we don't want LLC because there's no benefit of having um, rental properties in S corp. It could be detrimental depending on future plans regarding family and moving properties around the different entities. It has some negative impact. So it would really have to get a better understanding of. Well, I would have to get a better understanding of what these other businesses that this holding company uh, maintains.
Yeah, get a consultation, DeAndre. Okay, let me get you out of here, brother Larry. Good to see you. We'll try. If we can't do every week, we'll at least not try. We will do every 2 weeks. Is that fair to say? Can we put that on ink on make it a reality, Larry? We don't do every week. We'll do every 2 weeks.
Yeah, yeah. Like I said, we'll touch base in the week, see if what I know things come up and life happens. So we'll
Yeah.
we'll we'll adjust along the way, and if it has to be a different day, we'll make it happen.
Yeah. Okay. Round up. Much love to you. Tomorrow, 4:30 will be the land trust workshop, just showing you how we buy out and sell real estate without putting it in our LLC, neither in our name. Hopefully, you'll be there tomorrow so you can stop buying houses in your LLC. Thanks, Larry. See you soon. Peace,
Appreciate
y'all.
it. Good, a good one.